I'm delighted to have you here. This is a topic that we're all very passionate about, and the title of this session, this panel session, is the economic value of non-clear derivatives, over-the-counter derivatives used by non-financial firms, and topics related to that. This is a very recent topic that's been on the forefront of the news, and as of September 2013, the non-financial firms, for the most part, were cleared from mandatory over-the-counter clearing, and with certain special situations. I've got a panel of experts here, and so what I would like to do is introduce them first. I'll start off with myself. I'm Betty Simkins. I'm the Williams Company's chair and professor of finance at Oklahoma State University. And this is a topic I've done research with, and for the International Swaps and Derivatives Association, ISDA. And I've done a lot of risk management research through the years, and I've seen the value that the hedging in the over-the-counter markets offers for non-financial firms. And I'm delighted to have our first panelist here, Audrey, Constable, Blater. And let me just read just a little bit about Audrey. She's the Director of Research at the International Swaps and Derivatives Association, known as ISDA. She has her PhD in economics at Fordham University. Her areas of expertise are in policy economics, the value of OTC swaps and derivatives, stress testing best practices, and enterprise risk management, among other areas. She also, for example, fixed income factor analysis. She was previously at MSCI and then 5 years at the hedge fund AQR Capital Management. So we're delighted to have her and she will be the first speaker. Next, I would like to introduce Charles Cerria, and he's the Associate General Counsel at Hess Corporation. And Charles, he's also the Associate Secretary at Hess Energy Trading Company, LLC. He holds a BS in Accounting, MBA in Finance, and JD from Seton Hall University, and is admitted to the New Jersey Bar and is registered in New York as an in-house counsel. He is Secretary to the Derivatives and Structured Products Law Committee and a former Executive Committee member of the Business Law Section, as well as a member of the International Law Section of the New York Bar Association. And his group at Hess provides transparency of legal risk and counseling to each trading desk and senior management. It negotiates, reviews, and approves global trading documentation, including ISDA master agreements with its physical trading annexes, as well as power and natural gas master trading agreements and trading terms. And also, his group provides legal advice to corporate risk regarding commodity trading activities. Thank you. And then next we have Eric Hugson. And Eric is the Don and Lorraine Freeberg Professor of Economics and Finance at the Robert Day School of Economics and Finance at Claremont McKenna College. He received his doctorate from Carnegie Mellon University and has taught previously at Caltech, the University of Utah, and the University of Colorado. His main area of expertise in finance is in the subfield of market microstructure. And then I also have Robert Salvaggio. I said that right? He's partner and head of analytics at Rudder Associates. And I'm very delighted to have you here too. And he's joined Rudder Associate as a partner in 2010. And for those of you that may not know it, the prior co-editor with me at the Journal of Applied Finance was his colleague, Charles Smithson. And so prior to joining Rudder Associates, he was Senior VP and Head of Risk Analysis at Fidelity Investments Institution Products Groups. At Fidelity, he oversaw capital market risk, potential counterparty exposure, and risk-adjusted performance measurement. Prior to Fidelity, he was a Managing Director and Head of Capital Planning and Risk Analysis at Ambac Financial Group. And he also worked with other firms such as Chase Manhattan Bank. He holds a PhD in economics from Brown University. So, delighted to have each of you here, and just a few brief comments. The setting, we had the financial crisis recently, and this is where it began, the recent propositions for more intense regulating of the over-the-counter market. Recent regulatory proposals for margin requirements on non-clear derivative products could have resulted in dramatic changes to non-financial firms' use. And as of September 2013, most non-financial firms are exempt, as I mentioned previously. Kind of the backdrop for all of these regulatory changes are some assertions that we've all heard made by legislators and regulators and even a few academics. You know, for example, we do not agree with these assertions, but you know, some we've all heard are like over-the-counter derivatives are the or at least a major cause or exaggeration of the 2008 credit crisis. All useful derivatives can function on an exchange. The third one, it will be easy for good derivatives to make the transition to exchanges. And fourth, the only derivatives that cannot make that transition are going to be the bad derivatives that caused all of the trouble. And this is one where we've got research that disproves this, for example. So this panel is going to examine this. And next, I would like to start with Audrey. And if you would like to come up, I'll bring up your slides. You might want to come around here because of the camera. That's okay? Yeah, you can. Right here. There? Okay. Yes. Sorry.
Hi. That's okay. My name is Audrey Costabile Blater. I'm the Director of Research at ISDA, which is the International Swaps and Derivatives Association. For those of you that are not familiar, ISDA is a nonprofit trade organization whose goal is to facilitate safe and efficient OTC derivatives markets. One focus of the ISDA research staff is to provide thought leadership in the area of OTC derivatives. So to accomplish this, we regularly engage end users. End users account for roughly 42% of the global ISDA membership. That's the largest single contingency. End users include non-financial corporates, financial institutions such as insurers, banks, financial companies, asset managers, such as institutional investment or mutual funds, as well as alternative asset investment managers. End users also include governments and sovereign entities. This year, in February, ISDA conducted a survey of end users on issues and trends in the OTC derivatives markets. A total of 245 firms were surveyed. 42% of these were non-financial corporates. 49% were financial institutions. So financial institutions include insurers, finance companies, asset managers, and bank end users within the scope of the survey. Regionally speaking, the majority of representation was headquartered in Europe, about 45%. 41% was headquartered in the US, and then the rest was headquartered elsewhere, mostly Asian. Okay. So there were several interesting trends that were highlighted in the survey. First, represented by this slide, according to survey findings, the demand for OTC derivatives by end users remains quite strong. 86% of survey respondents believe that OTC derivatives are important to their risk management process. So that includes the red and green slices of the pie, as you see. As a result, more than 3/4 of our respondents indicated that they expect to increase or maintain their current level of derivatives activity in the second half of 2014. Participants pointed to changes in interest rates. So for example, they saw interest rates in developed economies, I guess, eventually going up, hence the reason they needed to continue their current risk management strategy. They believe that FX rate volatility, particularly in emerging markets, was a factor to maintain a steady course. And to a lesser extent, commodity and equity price volatility also was a motivation for continuing to use OTC derivatives for hedging purposes. Those that suggested they would reduce their OTC derivative uses mainly attributed this to a reduction to higher costs. They expect to access more cost-effective alternatives, especially in developed markets. So in other words, maybe they can access the futures market. Maybe there is some sort of alternative that they can use in developed markets, but in emerging markets this wasn't the case. And some of this was highlighted in Betty's paper, if you had taken a look, that there just are no alternatives at times. So as OTC derivative market continues to evolve and miss significant changes, one thing that's clear is that end users around the world would want and need the ability to use these instruments to manage their costs, arising from business and financing activities. So to further investigate this, I've moved on to my next slide that speaks to the changes and challenges to end users. Our survey asked several questions relating to specific regulations and the overall state of financial markets. It's probably not very surprising that most end user respondents agreed that the financial system is safer today post-regulation. In fact, 57% felt this way. The top factor in enhancing safety is tighter credit risk management. And of course, a lot of the regulation focuses on this. 86% of respondents indicated that that was either very important or important. Other factors, which I've highlighted here on the slide, which were rated highly as an input to improve safety in the financial system, included capital requirements and a reduction of leverage. And what's interesting is that some of the factors that were rated lower as contributing to the safety of financial markets included trade execution requirements, central clearing mandates, and transaction reporting requirements. And you'll see as I go on in my slide deck that many of these things prove to be quite costly, and the efficiency versus cost comparison really didn't work out. Let's take a look at my next slide. So we'll focus here on the new trade execution requirements because many of our members felt that these were quite cumbersome in terms of onboarding from a legal perspective, from an operational perspective. A lot of resources were required. We found that roughly 3/4 or 74% of end users believed that new electronic trade execution requirements for OTC derivatives in the US and Europe will in fact have a positive effect on transparency. So there's not really much of an argument there. If you're using an electronic platform, prices become more apparent. However, this transparency came with a cost. More respondents believed that the negatives outweighed the positives. So this is the metric for transparency, but if we compare it to some of the negatives, for example, there are three key areas where this is prevalent. So in other words, prices go up, liquidity goes down, and ease of use goes down. So this efficiency versus transparency theme continues throughout the survey. When we weigh the regulatory benefits and costs on this slide, what we find is that 68% of end users believe that the new financial landscape results in higher hedging costs. So that's our blue bar. Well, an overwhelming 81% believe that the administrative costs have gone up, which is the purple bar on the right. And that's the theme that we keep hearing a lot about, this onboarding, this hiring of new employees, this legal framework that continues to be overwhelming for some people. The light blue bar also catches our eye. That's where respondents felt that collateral requirements related to hedging are too high. It's important to note that previously many of these end users were never expected to post initial margin to a CCP or central clearinghouse. So naturally, now that this has changed, the response is echoed in the survey that these costs are quite high. Some participants felt that increased transparency made hedging easier and agreed that clearinghouses did reduce risk. So we see both sides. However, these responses were more muted. Lastly, before I move on, there was no change to hedging. So in other words, people, I think what this result speaks to is that in some cases you just can't change how you're doing the hedge. If it costs more, you still have to do the hedge. And that cost, of course, gets passed along somewhere, which we didn't touch on in this particular survey. ISDA has researched and published several reports related to swap execution facilities, which are known as SEFs, as well as footnote 88, the definition of a U.S. person. And we do this to gauge the impact of such regulatory changes and their effect on the market and market fragmentation. You've probably heard a lot about market fragmentation lately. It seems to be discussed in the media quite a lot. So we went out to our clearing members to gather some data on this. In this case, we used LCH data to try to measure the scope of market fragmentation. Our research findings and our survey findings both agreed that there was this existence of market fragmentation. So for example, if you look at this chart using LCH, London Clearinghouse data, we found that following the October 2013 CEF rule implementation date, a larger, more exclusive market for European interest rate swaps was available between non-US dealers. So what you see here is if you look at the red line, you see sort of the yellow highlighted areas when the rule was effective. The red line going down tells you that European dealer transactions with US dealer transactions had dropped in the market for euro interest rate swaps, whereas if you compare blue line, that's European dealer to European dealer trading, that's gone up in terms of notional volume. Which tells us that there's a more exclusive pool for European IRS. Now, US IRS was interesting because that's more of a shared pool. However, we feel that CEFs themselves are more US-centric markets. So you're seeing this breaking away of liquidity pools. The survey tells a similar story in the findings. Given the lack of regional cohesion, and the timing of the rules, it's not surprising that about half of the respondents agree fragmentation is occurring along these geographic lines, which is shown in the first green bar. The majority, or 61%, believe that this fragmentation has a negative impact on their firm's ability to manage risk, potentially because they have access to less liquid markets to use these tools. Much of this is attributed to increased costs that result from different liquidity pools for different participants. 83% of our survey respondents felt that way. On my last slide, shortly after our survey closed, our end user survey, some swaps became made available to trade, or MAT. That meant that they must be traded on a swap execution facility, or SEF, and could legally no longer be traded bilaterally. So the survey doesn't capture the effect of this. However, our research found that CEFs were mostly US-centric, and we talked a little bit about that breaking off of liquidity pools, and that this dynamic became even more apparent once certain USD, Euro, and GBP swaps became made available to trade this past February. So the highlighted area is when the MAT rule came into effect. And what we see here is that Euro made available to trade swaps, the red line, have again sunk down, and this is within the CEF liquidity pool now, whereas the blue line, USD, swaps have gone higher. So in other words, USD swaps have become a larger percentage of the swap execution facility liquidity. So if you're a person trying to access Euro or GBP IRS, now you're dealing in a very US-centric or USD IRS-centric liquidity pool. There were many in the survey that felt that once MAT did come to fruition, that liquidity and market fragmentation would be further impacted. So we clearly have some future work to do, which will probably continue to focus on similar issues, and especially how they will affect end users. So I think I'm going to stop here. I'm not sure. Do questions come now or
At the end.
at the end?
Further.
Okay. Thank you.
So if you have any questions, jot them down at the end. I would like to give time for each speaker to speak first, and then again we'll open up Q&A at the end of the session. Okay. Well, next I would like to invite Chuck Cerria with Hess Corporation, and this is going to be the non-financial, the end user's view, and we're very excited to have you here. And the clicker is here. Oh, let me bring you up.
Oh, good idea. Hello.
Okay. There you go.
Okay. Hello, everybody. It's really nice to be here. I appreciate the invitation. This is a very important topic, as Betty said initially, and we are all impassioned about it, actually. So let me launch into it. And the first thing I'm going to do, since I'm a lawyer, is I'm going to disclaim. Okay? These are my opinions only. not to be attributed to anyone else, including my employer, okay? And none of what I'm going to say or is contained here is legal advice, okay? So, I wanted to start by emphasizing the physicality of the need, okay? And when I train my team over the years, I always tell them that physical commodities are the alpha and the omega of trading, okay? And we all need to realize that this has literally been going on since the beginning of time. It's not anything that was flourishing in 2008 only. We're talking about physical commodities, really the essence of society. And it's not just energy, okay? It's agriculture, the food we eat, okay? It's metals, okay? It's these basic things that we as a society take for granted pretty much today. The lights are on now, and the air conditioning is going, and we're all enjoying that. That's all physical commodities being delivered here and now, right now, okay? So, from an energy standpoint, again, which is where my experience lies, you have crude oil, you have refined products, and refined oil, and you got high-end jet fuel, gasoline. You have distillates, heating oil, diesel fuel, and you have residual heavy oils, 6 oils, for industrial heavy heating purposes. Ships' bunkers. Bunkers are the fuel for ships, okay? Petrochemicals, those are the intermediate products necessary to make finished products. Okay, like for instance, they add the octane to gasoline, they add oxygenate to gasoline to satisfy EPA rules, okay, that have been in effect since the rules themselves came in about 1994, basis the 1990 Air Act amendments, electricity, coal, and natural gas. So before we talk about financial structuring or over-the-counter derivatives, I want to make sure we're set with the need here, and it's a physical commodity. Okay. So, energy prices, as you know, are very volatile. Okay. The sources of energy are located in geographic areas where the demand is not really there. So when you take supply and demand, you have the world, and you need to get it from the source of supply to where the demand is being called for. Okay, and there's a lot of governments involved, a lot of jurisdictions in this world market for energy. And for many different reasons, which I'm not going to go into now because that's out of the scope of this discussion, the prices bounce periodically through the day, frequently, okay? We call it markets moving, and energy markets move often through the day. Okay, so Betty's paper makes the case phenomenally well about how OTC hedges, that is over-the-counter hedges, best match the risk of a product's drop in value below its cost before it can be brought to market. So, if you read my bio, don't bother, but I started out as an accountant for Hess, and one of the first things I used to do was a journal entry every month. When the value of our inventory dropped below cost, we had to actually write that down every month. It's called lower of cost or market. And it was significant. I actually programmed the program to actually compute market value and what our cost was, and every month was a journal entry. And you only need a journal entry if the market dipped below cost. You don't get the benefit if it goes above cost. So it's the interest of conservatism for financial statement preparation. So I know the magnitude, and it hits your bottom line, and you never get it back. Okay, so for oil, it takes about 180 days to take it out of the ground, gather it, produce it, refine it, store it, get it through the intermediate steps to the ultimate consumers. Okay? So a lot can happen in the market during those 180 days. As I said earlier, prices are always very volatile. Over-the-counter hedges are better and work better than exchange-traded derivatives, and I'm going to defer to Betty's paper for the specifics there. She did a phenomenal job. I just want to highlight a few things, okay? They're privately negotiated, so we negotiate with our counterparties, we call them, and, you know, we as the hedger, if I'm speaking from a Hess Corporation standpoint, we have needs from a volumetric standpoint and you know, geographic standpoint that are not easily met, and in fact not met from a correlative standpoint with exchange-traded derivatives. So we need to privately negotiate them to best achieve the hedge. Okay. Now, when I'm on the trading side, like I am for Hess Energy Trading Company, they're a trading company around the world that makes markets and enables people, enables other counterparties to hedge. So I've seen it from both sides, and it is a very vibrant, necessary activity. I mentioned in the earlier slide jet fuel, okay? Well, you know, the price of jet fuel, volatile too, okay? We all fly, I know I fly often, and you know, when airlines hedge, because they need to hedge the cost of their jet fuel, airlines are very big users of OTC derivatives, and I can tell you we trade with them on the trading side because they need to stabilize their profitability, and that's how they manage the cost of the jet fuel. So these are all living, breathing things that we're talking about. This is not pie in the sky, you know, concepts. Okay. When we privately negotiate, we innovate and we meet our needs on a daily basis now, on a now basis. When you have an exchange-traded instrument, it's in the rules. You either take it or leave it. You have lot sizes. You have geographic delivery locations that are set, can't be changed, and you know it doesn't work for the bulk of the business. Capital. 2008 was a hard year. We're still rebounding from it. Remember, these are my own comments, my own opinions. Okay, we're still rebounding from it. Capital is still short. We're not capital rich as a world economy. Liquidity is strained all around the world. Okay, just by virtue of 2008 and what happened there. We've been trading, I've been doing this since 1998, okay, over-the-counter derivatives and trading. And I can tell you that when we enter into a trading relationship with a counterparty, it's a very detailed process with a lot of due diligence. Betty mentioned credit before. My credit officer is, you know, right next to me through the day, okay? Because we have to make sure on a daily basis what's going on with all our counterparties. There are about 1,100, okay? So that department works very closely with my department. We effectuate whatever the credit department thinks they need to mitigate risk. And we've been doing a really good job for the last 16 years. We've been through major bankruptcies like Enron, Mirans, and what have you, PG&E, and we've done very well, okay? Because we're very vigilant, and we're on the mark, and we negotiate. When we negotiate, part of what we do is we negotiate margining arrangements, where we give credit based on the value of their balance sheet up to a certain threshold, and they only have to pay margin after that, and we get the same treatment on our side. It's purely bilateral, okay? Nothing punitive in any of our provisions. They're equally bilateral, and we have an adequate assurance kind of mentality so that if things start to go south, in my credit department's view, we can shrink the threshold to zero, or we can make an adequate assurance demand. So it's based on UCC 2-609, reasonable expectation that my counterpart is going to pay, okay? With a very short grace period, 48 hours. I told you how volatile the markets are. These kinds of practices have been in place now for 16 to 20 years, actually, even before I started doing this stuff. It's nothing new. Netting. Told my wife and my kids, actually, I want born to net on my tombstone, okay? Because I really do. You know, loving husband, great father, hopefully, good grandfather, and born to net. When there's an issue, if if there's an event of default or a termination event, and I have the ability to collapse all the positions, I want to collapse all the positions, and I want to net them all together, okay? So if I'm trading physical, and if I'm trading derivative, I want to get it all down to one number, okay? And whoever's in the money gets paid, period. It's not punitive as to who the defaulting party is, okay? That is the key to navigating through trading, okay? Because these things happen. I can tell you over the years since I've been doing this, there's roughly, without exaggeration, about 16 times when we've had to go through this. And we do it, and it works very well. I'm not going to give you any particulars, but we're presently now finishing our settlement negotiations with the Lehman estate. And we've been through that. And we have multi-entity trading all around the world that we're successfully netting. And so, you know, you need to rely on local netting opinions in the jurisdictions of your counterparties. This has got nothing to do with the governing law, really. It's got all to do with where your counterparty is from. And if they file bankruptcy, you're subject to that jurisdiction's insolvency regime. There's a number of opinions published by ISDA and other organizations that we rely on a daily basis to navigate through our documentation, and we use them in the event of insolvencies. Okay. By the way, let me go back there for a minute. Financial reform measures that have been instituted since 2008, in my opinion, at times frustrate netting, okay? Now think about if you're going to take the OTC bilateral swaps and force them to exchanges on clearinghouses, okay, that gets an entirely different insolvency treatment. You're no longer available, the bankruptcy safe harbors are no longer available to you to use. Once it becomes a cleared instrument, it's up to the insolvency of the clearinghouse, and it takes it out of my ability to net with my other stuff, my other OT, over-the-counter stuff. So my physical contracts are going to be left, you know, in one bucket, not nettable with the derivatives that were used to hedge them. Now, that hasn't happened yet because commodity derivatives have not been forced into U.S. clearing mandate yet. We expect that will happen end of this year, beginning of next year. Interest rates are in, credit instruments are in, commodities are not yet in. Okay? So I'm forecasting, you know, that if and when that does happen, it's going to cause netting issues, and, you know, unfortunately, from, again, my opinion, we're going to be inserting risk where there wasn't any risk before. Okay? So, OTC derivatives. Credit reporting agencies encourage, and in fact, in our case, mandated it. We were, years ago, we had a project, about 6 years ago, to take derivatives off exchange because the margin obligations were too high, and the credit reporting agency said, you know, you're not getting any return for this capital. So we negotiated with OTC counterparties who were investment banks, okay? There were 5 of them. And we moved our positions off exchange, and we liquidated the exchange positions, and we simultaneously got into OTC positions to change the risk profile. And that reduced our cash capital outlay for margin. Okay. Also, when it's typical when you're financing large capital outlays, like for instance building a power plant, which we've done in Bayonne recently. Okay. Banks require hedges on, let's say, any loans that you have from an interest rate standpoint. It's part of the document, part of the closing conditions. So these are really ingrained in best practices in the United States and have been for decades. Okay, challenges. 2008, first of all, in the opening slide, again, my opinion, derivatives, OTC derivatives were not a cause of 2008. In fact, they helped, okay? Wall Street bailed out Main Street because to the extent that you attribute the real problems of 2008 to the mortgage crisis, I think manifested itself then. Those credit derivatives rolled up risk and allocated risk to the risk taker. And it's unfortunate that we had a few investment banks that we lost or that we almost lost. Okay? But in my own opinion, it's better than that happening than the 400 to 500 banks who gave out those loans failing. Okay? So, the challenges here is, what is an OTC derivative? To what extent does it include a physically settled contract? And in the U.S., the CFTC has tried, and Congress has tried, to say that if it's a physically settled contract, it's not a swap and it's not regulated. But the problem is when you get to optionality in physical contracts, sometimes they can turn into a swap. So there's the algorithm there. I'm not going to go through it because I don't really have time. But there's a danger, and we live with it now where we classify every transaction. We need to make sure we classify it correctly as either a swap or not a swap, aka a forward contract. And it's difficult, okay? And when we do it, and our counterparty does it, we may very well come to different conclusions on the same transaction. The EU is defining, the term there is financial instrument instead of swap, and they're including any physically settled contract traded on an electronic trading platform that's a multilateral trading platform. They're mandating that to be cleared as a financial instrument. It's going to be interesting. Now that hasn't happened yet. That's in the law, and we expect that to try to be implemented over the next year or two. Okay, I kind of covered this before. And then, to the extent that we deal in these instruments, should we be regulated as a swap dealer, major swap participant, financial entity? So if any of us turn into financial entities, it's a different insolvency regime. Just want you to know. So the safe harbors are again at risk there. The end user exemption doesn't apply. And capital requirements, that will be new and unrelated to the fact that we have billions of dollars invested in infrastructure in the energy industry. Hopefully those capital requirements will take account for that. But they're still proposed, so we don't know. Position limits is a US phenomenon and an EU phenomenon, which will affect our ability to trade physically settled contracts and to move commodity. You can read the details. So, my closing comment is, let's not insert risk where it did not already exist. Let's protect the financial integrity of physical commodities and monitor these topics through the G20. This is a worldwide phenomenon. Since 2009, when the G20 was first formed, it's the US, EU, Singapore, Hong Kong, India, Australia, Brazil, Canada, and whatever that number is, minus 20. That's all I have. Thank you.
Thank you very much, Chuck. And if you have any comments for Chuck, again, there will be time at the end, so please jot them down. Next, I would like to invite up Eric Hewson to present. I will bring up your slides.
Thanks very much for having me. And I'm glad to have gone third because I got to hear some of the concerns from the practitioner side. Being an academic, of course, I know much less about that sort of thing than any practitioner would. So I'm here, I guess, to present the academic perspective, or an academic perspective on this. Supposedly. Oh, yes. So we've been talking about recent regulatory proposals for margin requirements on non-cleared derivatives. And we've heard reasons already why that could affect market participants to use them. Now, right now, it looks like it's okay because non-financial firms at least are exempt from these new requirements. And we've heard reasons why these things might be costly. Now, I'm an academic, so I wasn't really sure what levels of regulation were actually possible. It seemed like there were a lot of things that could be done, and it wasn't really obvious to me what would be done, even after the discussions. So I thought, well, one thing you could do, maybe the worst thing from Betty's perspective, is you could put these things on an exchange and have every contract standardized, have public disclosure, you'd have margin requirements, everything would be one size fits all. And we've already seen, in Betty's paper, we've already seen a little bit about what might happen in that regime. And then there are various versions of where the contracts continue to trade over the counter. And you could have a lot of things happen. The contracts could be cleared. There could be margin requirements. There could be maintenance margin, for example. Or the contracts could be cleared and there might not be any margin requirements. That would be possible. Or maybe you could have margin requirements but have the contract not be cleared. Or what you could have is what you have now, which is you're not cleared and there's no margin requirements. Although that doesn't mean there aren't any margins ever, because in fact, there's nothing that says in a bilaterally negotiated contract that you couldn't, in fact, negotiate these margins if you wanted to. And you would think that that's the kind of thing that would happen if it was cheaper and better to do so. So if you go to the exchanges and you go with standardization, then what's going to happen, we saw it in Betty's paper, which we all read, it turns out that what you get is if you replace a custom contract with a bunch of exchange-traded ones, then you don't get to hedge exactly the risk that you want to hedge necessarily. And so you might not be able to hedge price risk or interest rate shocks or anything as well as you could with a customized contract. And so we have some numerical calculations in various situations of how that might work. Now, of course, standardization does have a benefit. I mean, potentially it could improve market liquidity if everyone traded the same thing. There could be, on the other side of the contract, I suppose, there could be some bespoke-driven basis risk that would be eliminated. You wouldn't have that. It would be easier for the market makers to hedge on the other side, maybe. So that's possible, although, and that would matter because from the perspective of those market makers, that if they have this extra risk, they would have to pass through this cost to the non-financial firms when they're going to trade. It doesn't really matter who you impose it. One of the things economists do, they think, well, maybe you have the Coase theorem in there. So it doesn't really matter whom you impose the costs on. When you have the trading arrangement, somehow this all gets worked out and the costs get split somehow. And so this could be a benefit to the non-financial firms as well, potentially, which isn't something that would be so easy to measure, but you could imagine that it would be there. So what about public disclosure? Again, it seems like a non-issue for non-financial firms. If all these non-financial firms are hedging, then it's not really going to matter so much from their perspective, unless public disclosure is expensive for them. And I hadn't realized how expensive that might be. I mean, if it is, then you have to worry about that too. I was just thinking that it could be a problem because if the market makers on the other side have to disclose these contracts, because you could imagine that the people who are trading on the opposite side of the non-financial firms have all kinds of over-the-counter contracts, and maybe for them you want them to be reporting everything. Then maybe that cost would be passed through. So I guess on both sides, which I hadn't realized, you have these costs that you have to worry about. Now, of course, public disclosure does potentially reduce opacity, and there are some papers in the academic literature who suggest that's good. If there is some kind of problem where counterparty positions, if things get really confusing, and this again wouldn't necessarily be on the side of the non-financial firms, it might be important for these positions to be reported so you know what the risk profile of big financial institutions on the other side of the contracts might be. Although again, for the non-financials, it's not clear. It's not clear what the problems on that side. And I think people are sort of aware of that, and even I'm aware. So then we have the issue of margins. So what should you do with margins? So, mandatory margins can be expensive, right? I mean, maybe they reduce the risk of catastrophic default, but you're thinking, and I guess I've heard this echoed now by practitioners on this panel, is that both of my previous panelists said that a lot of non-financial firms think that they're worried that margin requirements that would be set would be too high. And yeah, that would be a real problem if the margin requirements were set too high. So that would be a good reason to let counterparties set the margin requirements or lack thereof, depending on the contract themselves. Because after all, again, the counterparty to the non-financial firm is going to have to agree to the terms. So it's not like they're just going to let there be no margins if it's important to have margins. If you're worried about large price fluctuations, then presumably there could be margin requirements set by the counterparties in the bilateral arrangements. So who cares? So at least that's my view. Why limit the counterparty's ability to negotiate margins? I'm just not really seeing that. So here's an extreme example, which is probably wrong, but it was an example I thought about with futures versus forwards. So I always think about a farmer. So when you have a farmer has a crop, and let's say you actually knew how big the crop was exactly. So let's abstract away from any uncertainty about how much crop there is. So they negotiate a forward contract. They're going to sell this commodity at a fixed price in the future. So they set up a forward contract to do that. And suppose the spot price rises. Well, it's okay. The producer loses on the forward contract. It really doesn't make any difference. I mean, they've locked in. Presumably, they could have done better by not hedging, but okay, that's fine. I mean, they presumably they're hedging risk. But the problem is that if you have the commodity available as collateral in a forward contract, nobody cares. But suppose you had to have a future instead. Well, if you have a future instead, and you're short futures, and the price rises, then you have to mark to market, and you're providing margin all the way along. There's an example we teach in energy that's kind of the same thing with Metallgesellschaft, where they had a bunch of forward contracts that they negotiated, and then they hedged in the futures market, and the futures price moved against them, and they didn't get wiped out by having to mark those futures contracts to market every day and post margin. But in fact, they lost like $1 billion doing it, and then the central Metallgesellschaft in Germany closed down the whole position. And so that's the kind of thing that's bad. So you certainly don't want to impose these kinds of requirements if they're not necessary. Now, in my example with the farmer, it's pretty simple. You know that the farmer's hedging, and presumably you could provide an exemption for something like that. But in a more complicated situation, maybe it's not so easy to do that. And so if it's harder to distinguish a speculative position from a hedging position, well then I don't know what's going to happen. Probably some of the time you're going to classify a hedge as a speculative position. Again, I can't really provide a good example. You guys probably have plenty of examples for this. Me, what do I know? I know this could happen. You know, theoretically, you can tell me when or how often this happens. That would be a real problem, because then you're going to force people perhaps to mark to market when you didn't really want to do that, and that is going to add, as we heard, that's the kind of thing where you're adding risk where you didn't have risk before, and that would be bad. So you don't really want to do that. And then if you're worried, you know, it's one thing if you're worried about giant financial corporations who you're worried that they're too big to fail. Well, those guys, maybe you want to have to regulate them a little bit in some way, so they can't take on risks that you don't know about, maybe. But when we're talking about non-financial firms, although I'm getting a little nervous now when I hear about 1,100 counterparties for Hess, maybe they're bigger than I thought. But let's...
Hess and Hedco, yeah.
Okay. But even so, I'm less worried. It's not like I'm worried most of the time that these guys, if they actually did fail, are going to bring down the whole financial system. So yeah, people go broke. That sometimes happens in the world. But it's not like there's going to be this catastrophic cascade if one of these things happens. So what kind of regulation are we talking about? So that's, it seems to me, when I thought about this, I thought, well, I'm going to be able to talk about my research. But really, all these problems, there are these large costs associated with requiring these non-financial firms to have to post margins or regulate them more than they're currently done. Now, the stuff that I worked on, my co-author here, Saf Bernstein's in the audience. He's discussing a paper later today, and Mark Weidmeyer. what we wanted to know is we wanted to know if there was actually a benefit to having things be clear. So what we did, so what we wanted to know is, would you actually reduce counterparty risk by clearing in any way? And of course, our situation, I'm not sure that this is the most important concern for non-financial firms. But what we did is, if the reduction in counterparty risk was enormous, maybe it could offset the cost of market to market, something like that. Although it's not at all clear to me that that would happen. So let me tell you what academics did, and then I'll tell you what we did quickly. So what academics did, in theory, one of these things Duffy and Zhu talked about, and I wanted to mention it because it dovetails with something that a couple of the comments made earlier, was that more netting reduces the likelihood of default through contagion. So netting was good. That's Duffy and Zhu's paper. Now they said one clearinghouse is good, but then they started saying, well, you know, the problem is if you have fragmentation, and they were actually very worried about this, that if you have multiple clearinghouses, which isn't exactly the same as multiple markets, but it's kind of like it. If you have multiple clearinghouses, then what happens is you may get less netting, and then they made another point, which was also made earlier, and that was, you know, when you have some contracts are bilaterally netted because they're traded, the counterparties net things out, and then other contracts are traded through a centralized clearing party. What happens is the introduction of the centralized clearing party might interfere with the bilateral netting. And so there's sort of, it's one thing if everything is clear. It's another thing if everything's bilaterally netted. And then if you're in between, it can be really, it's not so good. And so I think that's the situation that you were talking about before, that could happen. So that's kind of, that sort of theoretically, those were the main issues. Now, Acharya and Bison also talk about opacity and how that might be a bad thing. Now, empirically, people have looked a little bit to see what happens when you introduce a clearinghouse, and mostly they find things like the value of credit default swaps, the swap spread goes up when these things start to be cleared. And that's a good thing. The only problem is this. So I don't know about you, but I've got a cold in my life before. I used to get a cold like once a week. And one of the things sometimes you do after 9 days of having a cold is you go to the doctor and you get antibiotics, right? And then on the 10th day you get better. So you attribute it to the antibiotics. Now, I don't know. It seems to me that one of the reasons why these things got to be cleared in the first place was that maybe, just maybe, there was some kind of financial crisis which made everybody change the legislation. And then when you're in a non-crisis period, like things went back to normal, maybe if you did nothing, things would also have gone back to normal. Now, it's not like these guys don't try to control a little bit for this sort of thing, but it's kind of hard to do. So that's what we did. That was our main innovation. We said, look, what if you had the same security traded in two places where it's cleared in one place and not cleared in another? What happens when you start clearing on the exchange where you didn't clear before? Then what happens? So that's what we did. So it turns out that this happened way back in the dawn of time. I think it was the Eocene, so that's before the Pleistocene. And in the Eocene, the New York Stock Exchange, stocks weren't cleared. That one didn't happen until 1892. So before that, there was also another exchange where things were cleared. And so what happened is if you look at the difference in the absolute value, if you look at the price difference between what was going on the NYSE and the Consolidated Exchange, which was the other one, it turns out that the difference, the absolute value difference fell by an enormous amount. And you see there's this little line there where 80% of the stocks were clearing. That's because things are phased in over a period of a few years. And you can see that dropped. You had less it looks like you have less volatility, which is a direct consequence of this. And you also had and also the average price in New York went up a little bit. So clearing increased the New York Stock Exchange values by 24 basis points, which is not enormous, but volatility dropped by maybe 1%, which on a stock which had volatility of 30%, that's like a 3% drop. So that's essentially what we found. It turned out that there were other consequences which were kind of good. It turned out that prices on New York were no longer affected by changes in interest rates to the same extent that they had been before. And that one of the things that was nice was it wasn't just, what was important about clearing is you wanted everything to clear. Because it wasn't just that your stock, the fact that your stock cleared helped a little, but the fact that other people's stocks also cleared, I'm close.
Okay.
Was a large effect. And so we found, this is what we found. And we thought, well, that's sort of nice. So maybe perhaps, possibly, clearing could increase the value of over-the-counter derivatives. But we've seen there's cost to this, and also, if people have a choice, I think the most important point is that these investors have a choice. You could trade on exchange-traded contracts now if you wanted to do it, okay? But people aren't doing that. Even back then, the clearinghouse, it's not like there was a regulation required for the clearinghouse to be phased in. Now, maybe there were people on the other side of the issue, and there was some kicking and screaming about opacity and some of the same concerns we have now. But in fact, it turned out that the Cleveland administration did not get involved. Senator Blaine did not propose legislation, did get Mark Hanna to sign off on it. There was no legislation. They just did it voluntarily because they thought it would be better. So if you think this is going to be better, you do this voluntarily. It's not obvious to me why you need the legislation to make the change. Why you need a regulatory change at all. Buyer and seller can agree to margin if they need it. They've been doing that already. There's not really a too big to fail problem. Well, maybe for GM there's a too big to fail problem. But unless you're GM, it's not really a big deal. So I guess my view, which sort of surprised me coming to this, is leave it alone. That's it.
Sounds great. Okay, thank you. Next, I would like to have Robert, who goes by Bob, Slovakia, to come up and present. And it's all very interesting, very important to the markets. This should,
That's work.
yeah, there.
I also see.
Oh, that works too. This works too. I have two. Figure out later. Oh, okay. Oh, thank you.
Good morning. We're going to talk a little bit about how risk management policies, internal risk management policies, can make OTC derivatives more valuable. Much of my work at Rudder Associates and the work of my partners and our staff of quants, financial analysts, is around the helping clients on both in the dealer community and in the end user community pretty much get out of the messes that they've gotten into by using OTC derivatives. We don't tend to use the words selling and buying. Let's say transacting OTC derivatives. So we're going to just start with a base assumption that derivatives contracts can add value through their risk management application. When I first started working on derivatives, I wrote macro at university, and when I was putting my dissertation together, I used derivatives to show how derivatives can be an institutional factor that can help lead to rational expectations solutions in the economy. A lot of my research was supported by the Chicago Board of Trade, by Stanford Food Research, and by AEI. But one of the conclusions that we came to back in the 80s was that the key advantages, social advantages to derivatives, were first risk transfer or risk management. And risk management doesn't always imply minimizing risk or reducing risk. Increasing risk is part of risk management as well. So you've got hedging and speculation. Two basic uses of derivatives, hedging and speculation. I'm going to argue that we've got to get rid of the euphemisms. You're either hedging or you're speculating. What I find in my experience is that few people make the mistake that they're actually hedging when they thought they were speculating. Generally, what we hear is that people say they were hedging. No matter what they're doing with futures, they're hedging. And of course they're not, they're speculating. We'll talk about that in a minute. So clearly, risk transfer, key reason, key justification for futures. And in the 80s, I worked on part of the studies with the Fed and the SEC and the CFTC on the rationale for futures contracts. Second reason, very important reason, price transparency, price discovery. Key reason, key justification for the use of derivative contracts. Does risk management add value? Yes, it does. Absolutely. Risk management adds value. I think that Kenny Fruit and Jeremy Stein pretty much have the first and last words on that. There's no doubt about it that there are certain conditions under which risk management, active hedging is going to add value. Betty and others have shown that non-clear derivatives in particular can add value to an enterprise. They're customized to particular risk management needs. One-stop shopping, so there's no need to manage a portfolio of replicating options. Most of the over-the-counter derivatives that I encounter, and I've encountered through my entire career, both through consulting and through actively running risk management groups, can be replicated with a simple combination of options and futures. So most can. Many can. Incomplete markets, and this is where you've got an issue. Specific OTC contracts may be the only hedging game in town, short of cross hedges with significant and potentially costly basis risk. So the cost of that basis risk, when you're looking at a cross hedge, has to be weighed against any cost of going into an OTC derivative. And clearly at Hess, it was determined that the cost of the basis risk is higher than any of the costs that are associated with OTC derivatives. However, non-cleared OTC derivatives value add is often suboptimal. And too often, in our experience, in my experience, both as a risk manager and a consultant, and too often negative. Why? Well, often these derivative contracts are too complicated for less sophisticated market participants who don't know what they don't know. So what's going on very often is that less sophisticated market participants are dealing with some of the smartest quants in the world. There's a reason that sometimes quants are called rocket scientists. I have a staff of eight quants. 2 of them literally were rocket scientists. But clearly they're rational economic agents and they go where the money is. Lack of transparency in valuations. Talk about mark-to-market. Many end users have no idea how to mark-to-market their derivatives and don't even understand how expensive it is to do that process. We'll talk about that. Lack of transparency and sensitivities to key risk factors, to the derivative itself and to the asset or liability being hedged. Many end users have no idea what the key risk factors are of the OTC derivative that they've transacted, let alone the key risk factors to the underlying assets and liabilities. Lack of readily available risk-neutral pricing data. The data that are required to value properly and to sensitize for risk the derivatives are not always very easy to find. Everybody thinks, okay, you hit a couple of buttons on a Bloomberg screen and you're going to get those data. Not at all the case. Especially we find for spread product, equity basket transactions, CDS on CDOs. Key issue that always comes up is where do you get your correlation data? And the last thing you want to do when valuing a derivative, maybe not the last thing, but one thing you'd rather not do is use historical data. You don't want to just go and use historical data and plug in historical results to try to get the price of a derivative. By and large, it just doesn't work. CDS on CDO tranches, I'll just make one comment about that quickly. Most of the fuss and most of the call for increased regulation actually is as a result of these CDS contracts on CDO tranches. So the CDS that might have been written on Abacus or Timberwolf or something like that. Not so much the derivatives we're going to be talking about, that I'm going to talk about for the next few minutes. The other issue is many of our clients, both sides, end users and dealers, really have trouble coming to grips with counterparty credit risk. Valuing counterparty credit risk is not easy. Calculating CVA or DVA, credit valuation adjustments, not an easy task. The other issue is counterparty credit risk real? Of course it is. I mean, look at Lehman. I mean, we heard that Hess is still looking to clean up that mess. We're talking almost 6 years. And many counterparties have still not settled with Lehman. We work with a number of them. AIG, the counterparty credit risk of AIG. Now, AIG did agree to post collateral. But what happened? What happened with AIG? Well, when they, at the date of their insolvency, September 16th, 2008, what had happened was Moody's had downgraded them. Collateral calls were far more than the liquidity that they had available. So they became insolvent. They had to be bailed out. Clearly, the monolines didn't have to post any collateral. In lieu of collateral, what clients were doing was they were accepting the AAA imprimatur from Moody's, S&P, and Fitch, and we know where that led. Here are some of the common statements that we hear. Well, this derivative contract was not a speculation. We weren't speculating. What we were trying to do was we were trying to reduce funding costs if rates move favorably. Well, what does that mean? How do you enter into a properly priced derivative contract and really reduce your funding costs? You would think that with rational agents you can't do that. That's a bet. That's a speculation. To the extent that municipalities were entering into municipal swaps, feeling that by issuing floating and swapping to fixed, they were reducing their funding costs, they were missing something very important. They were not reducing their funding costs. The counterparty credit exposure that they were accepting was probably equal in value to the perceived reduction in funding costs that they were receiving by swapping from floating to fixed. Here's another one. If I won on this derivative transaction, it would have offset losses elsewhere, and it would have served as a hedge. Well, there's no necessary correlation between the derivative and the underlying. Had they gone to Atlantic City or to Monte Carlo or to Las Vegas and happened to win at the Baccarat table, they could have said that that offset losses somewhere else in the balance sheet. I actually hear this. Here's one. This was a great one. Hedges don't actually have to reduce risk. They have to change risk. We were working for a client that was making this argument in a litigation. As soon as we heard this, we said, we're out. Whatever billable hours we had charged, you don't even have to pay us. We don't want to be any part of this one. This was a big banking institution that made this argument. Here's one I heard in my career in risk management. It's a hedge. I'll have someone find something in the balance sheet that correlates nicely. Well, what's going on here? It's an ARB of back then I think it was FAS 80. It's an ARB of FAS 133. So I did make these up, and it's not clear whether these market participants are too unsophisticated or too clever. I'm guessing they're too clever. Well, we think about information asymmetries, and we think about how important that is. And it's not necessarily the case that two counterparties coming together to enter into a derivative contract can really freely negotiate when one counterparty has an army of the sort of rocket scientists that I hire and one that can't afford that army. So we've put together a little index that we show some of our prospective clients that they should be thinking about when they think about the kind of information they have and when they think about their policies and whether or not they want to enter into a derivative contract or whether or not they want to get some advice on how to help them. And basically we say, how complicated or exotic is your derivative? First of all, we ask, is the underlying a single rate, price, or index? Or is the derivative based on, is the pricing and the payoffs on the derivative based on multiple indices? And we give penalties for multiple indices. Are there embedded American or Bermudan options requiring backward induction? How many end users can actually build the type of lattice that's required to value one of these options? I mean, how many of you are PhDs in economics in the room and know how to build one of these lattices that allow you to do that backward induction? I would guess most of the PhDs in this room don't know how to do that. Are derivative cash flows path dependent, or in general is Monte Carlo analysis required? Are they path dependent and backward looking, and is backward induction required? More penalty. Do the derivatives incorporate compound options? Do the derivatives have a character of perhaps call option on another call option? Penalty. Are all market implied values, risk neutral values, publicly and freely available? Probably not, and we penalize for that. Is the underlying rate, price, or index determined in one currency but paid in another? How many here know how to make a Quanto adjustment? Anybody? Okay, so how many end users, non-financial end users, are going to know how to make a Quanto adjustment for that kind of a derivative? Does counterparty credit risk exist? Is there a clearinghouse mechanism, or does CVA need to be calculated? 2 points if CVA is a pricing factor. CVA, credit valuation adjustment, the credit risk to your counterparty is a pricing factor that has to be priced into derivatives. I give a couple of examples of the sort of exotic derivatives that we see corporate end users involved in. TARNs and KICOs. So, knockout provisions. Downside not limited, but Upside, very much limited. No initial cost to enter into the derivative. Non-financial end users love that. They love to enter into derivatives where there's no upfront cost. Of course, they don't know that what the mark-to-market value of that derivative truly is when they enter into it. So they don't understand dealer profit. So the fact that they're not paying cash today seems to indicate, oh, there's no cost. That's not what cost is all about, is it? So the fact that they don't have to pay today doesn't mean there's a zero present value. Present value is usually very negative. Here's an interesting one, a dual currency swap. Pays coupons in the investor's domestic currency with a notional in the issuer's domestic with a notional in the issuer's domestic currency. Reverse dual currency swap. Pays a foreign interest rate in the investor's domestic currency. So what has to happen here? Two term structures have to be estimated and currency. And the correlation between the currency and the term structures and the interest rates have to be estimated as well. That's part of what's called the Quanto adjustment. Power reverse dual currency swap. These were big before the crisis. They're coming back. You can read about this. They're highly exotic and highly complicated. Non-sophisticated users find themselves in these all the time. Range accrual swaps. Basically, these are swaps where the payout is made for every day that, let's say, LIBOR, or a constant maturity swap rate, is within some range. So every day during the month, you see whether the constant maturity swap rate is within the range. And you'll earn interest only on that day. If it's outside of the range, you won't earn interest. These are often capped so that you'll earn a maximum return and then it kicks out. They're often based on not simply an interest rate, but they can be based on an interest rate and a spread between two interest rates, so that both have to be within a range. They're also often callable or cancelable. How are you going to go about valuing that, especially when it's a value of a spread, when you're looking at the spread being within a range? What do you need? You need a two-factor term structure model. So, how are we going to enhance the value of non-clear? These are all costs. These are all costs that are largely not being borne explicitly. So non-corporates, by and large, are not bearing the cost of doing this diligence. The cost is still there, however. How are we going to reduce that cost? Well, we need an increased focus on the appropriateness of OTC derivative products demanded by end users of various levels of sophistication. We need to make sure that both parties to a transaction understand the methods of valuation and the risks associated with the derivatives, including counterparty risk. And we need to make sure that those derivatives transacted are consistent with internal policies and risk appetites. There must be stated risk policies and risk appetites. Dealers need to examine clients' risk management guidelines, especially those dealing with the authority to speculate using derivative contracts. We need a clear understanding that derivative activities are either hedging or speculating, and we need to avoid all the euphemisms that are used for speculating, such as reducing funding costs. End users must articulate formally specific policies regarding derivative usage within their risk management guidelines. We need formal risk management guidelines that go to the board of directors, and what needs to be specified is who may transact derivatives contracts, what sign-offs are required, what contracts are permissible, what limits are assigned to each transactor, which counterparties are suitable, is speculation permitted, and we must define speculation. Is only hedging permissible? Who will mark the contracts to market and how often? If counterparty is marking the contracts, very often end users will rely on the dealer from whom they're taking this exposure to do the marking. Well, clearly there's some conflict of interest there. Somebody has to audit to make sure that that's being done fairly. Are contracts being marked to market internally? And if they are, who's in charge of valuation? How frequently are the values calculated? What models are employed? And how often are the internal models audited by third parties? Who's responsible for hedge accounting? We need for each transaction a non-technical description of transaction and its purpose. We need a full hedge effectiveness analysis. If a derivative is being called a hedge, let's see it documented. That means a stochastic and scenario analysis of hedge effectiveness. If it's a speculation, we need stochastic holding period return analysis and stress analysis. So we need to look at prospective returns. What might the returns look like? How bad could it be? How good could it be? a statement that the transaction is consistent with corporate policies and procedures, and a statement of the valuation and sensitivity models to be used. All right? All of these, if firms adopt all of these, my firm's going to make a little bit less money because we're not going to be invited to help clean up messes quite so often. I'm not so worried about that because I know how we can earn a little bit more money. Most firms, obviously, are not going to go out and hire a stable of rocket scientists from Columbia, NYU, Cornell, St. John's to do this work. It's much more efficient to hire outside consultants, independent valuation experts to do this work. And what do we do as an outside independent valuation expert? We show the prospective hedge effectiveness of the derivative instruments. We provide analysis of ongoing hedge effectiveness and risk transparency. We do simulations of standalone return on derivatives. We have all the models. We know how to run all the models. We know how to value all of these. We give our end user clients an estimate of dealer profit at the inception of every transaction. We do derivative valuation for them at regular intervals, and we verify collateral calculations. We get paid less for doing all of this than we do to work with the client's lawyers after they get into a problem. But I find this work to be a lot more satisfying. Thank you.
Thank you very much, Bob.
Yeah, John.